Hello, everybody. This is Jonathan, and I'm here to discuss 5 keys of what underwriters are looking for when applying for business financing. I'm here with one of my underwriters, Joe Vicora, and we're just going to go through a few things. Just to let you know a little bit about my background, I've been in the small business lending space for 10 years. I own the marketplace Sprout Lending. I am a BFA contributor, and I am a consultant or a business developer for a company called Libertas Funding. Joe happens to be one of our underwriters at Libertas Funding. Joe?
How's it going, guys? Hopefully I can shed some light on what exactly lenders are looking for in the small business lending market.
Okay, so what I want to do is just break down the 5 basic things that they're looking for. I'll break them down, and then we're going to go through each one of them individually to just discuss, the little nuances of what's going on, what the underwriters are looking for. So first is going to be time and business. The second is going to be cash flow. When I'm discussing cash flow, I'm talking about, the revenue, the health of the bank statements, and what payment the underwriters think you guys can afford. Also, we look at credit, both personal and business. We look at the industry type, and we look at the profitability of the business. So we'll break down each one of those things as we go along. So one, Joe and his team do merchant cash advances. All right, Sprout Lending is a marketplace, so that's only one product that we offer. So Joe's primarily going to be discussing MCAs or merchant cash advances, and I'll fill in the blanks when it comes to SBA loans and lines of credit. So first, Joe, why don't you talk about time and business? What are some of the things that you're looking for there?
All right, well, John, time in business is actually the single biggest risk factor when underwriting pretty much any file, whether it's a merchant cash advance, a line of credit, or an SBA loan. Over 55% of small businesses will fail in the first 2 years that they're in business. 70% of businesses that start today won't live to see their 10th anniversary.
Why do you think that is, Joe? Do you think it's a lack of financing? Is it just a lack of knowing?
82% of small businesses will experience some sort of undercapitalization in their lifespan.
Okay, that could be poor management. There's a wide variety of reasons why a business could fail. But let's talk about time in business just right off the bat. So for a line of credit, believe it or not, the time in business is only 6 months. MCAs, Joe, what would you say the
It's anywhere from 6 months to a year, depending on the shop you're dealing with.
Okay, and then also discuss how you tier out your risk scores.
So typically anything under a year is going to fall into what's called a starter program, which means it's going to be a higher cost of money for whatever deal you're writing. Once you get over a year, you generally fall into what would be called a standard pricing tier. So you're going to get whatever the average rate is for the product you're trying to apply for. Once you get out past 2 years, that's when you start to get into premium tiers depending on the lender. Okay. Out past 5, pretty much premium for every lender you're going to look at.
All right, great. And now SBA loans, in my experience, and again, I've written several, more than several. I can't even think about all the people I've financed over the years. But SBA loans, you need at least 2 years. Usually it's 3 years in business. So that's a little bit tougher to qualify for most people. The other thing I would say about, the SBA program that we have is that not only is it typically 3 years in business, you need a credit score above 680. It's going to take 30 to 90 days to get approved. And on top of that, you're sending in much more documentation. You're talking about 2 years of business tax returns, 2 years of personal tax returns, a debt schedule, 12 months of bank statements, an application. And from there, they may come back and actually ask for other things. They'll usually ask for, again, year-to-date financials and the prior year's financials. And what they're going to look for there is certainly profitability. They want to see revenue growth and things along that nature. Now, the next thing up is cash flow, and this is important because cash flow is the lifeblood of every single business. So, Joe, why don't you discuss cash flow a little bit from an MCA perspective, and then I'll discuss it from the SBA and line of credit side.
Yeah, of course, John. Obviously, cash flow is the most important thing that underwriters look at. It's what really tells us whether or not your business is being managed well and whether or not you're going to succeed. Now, cash flow means a few different things. We're looking at your average daily ledger, your average daily deposits, how many deposits you're doing a month, which means deposit frequency, and we're looking at, obviously, your NSF and insufficient funds activity. Obviously, we want to make sure there's money in the bank.
Okay, so when we go over that, let's kind of tear that off, right? Because I know and you know, but a lot of the people listening aren't going to know.
Hmm.
Let's just discuss what would be considered, especially when it comes to deposit frequency. What are you guys looking for? And again, Libertas is one program that Sprout Lending offers, but there's several others that will take less deposit. So what's your deposit cutoffs? What do you consider strong, weak, and high risk?
So typically we look for a business with an absolute minimum of 13 deposits a month. Now the reason we look to have a higher deposit business is that the smaller the number of deposits that a business has, the bigger the risk if one of those deposits should be a late pay or just not pay at all. Like I said, 13 is our minimum. Anything over 20 is what we would consider a premium, and obviously anything over 50 is, the best you can do.
All right, excellent. And typically, you're going to see restaurants have over 50. Some.
Typically, John, you see it in restaurants, auto repair, most retail trade shops.
Okay, great. So let's go on. I want to discuss this as it pertains to SBA. So SBA, they're going to want to see healthy bank statements. That's very important. It's really important in any type of financing that we're going to do. But for an MCA, what's your minimum deposit that you need to do to be able to get somebody financed?
Are we talking about volume or frequency?
Volume.
So volume, typically we look for a minimum of $12,500 a month.
Okay.
Anything smaller than that, it's going to be very hard for us to get you an approval.
Okay. And you're also looking to make sure that's consistent and not decreasing,
Yes,
correct?
obviously we want to see consistency in revenue, and we want to make sure your business isn't seasonal and we're heading into your slow season.
Okay, but if they are heading into your slow season, I just saw one of the approvals you put out. You put a varied payment structure that had reduced
payments. We can actually
payments.
tailor a program based on your seasonality, just to make sure that your payment is comfortable throughout the term of the advance.
All right, great. So, again, that's one of the benefits of MCAs is that they have flexible repayment terms. So for a line of credit, the bare minimum line of credit, you're going to need $25,000 a month for the last 3 months consistently, and you're going to have to keep about $1,000 in the bank at all times. And they don't want to see any more than 2 negative days in any 1 month and 5 over the course of your last 3 months. SBA loans works very similar to lines of credit in that regard.
Most types of lending are going to require those minimums, John. $1,000 in the bank per day, no more than 2 to 3 negative days. Obviously, merchant cash advances will allow you to go a little bit higher, somewhere in the 4 days per month range.
Okay, great. And then, just discuss payment to income. And when I say payment to income, what we're discussing is what is the max payment a business can afford. So I'm going to let Joe break that down from his point of view, and then we'll go on from there.
All right, now, John, different lenders have different schools of thoughts on exactly how much of a merchant's free income you can take up with the payment. Typically, in the merchant cash advance industry, it ranges from anywhere from 12% to 30% at some of the more high-risk lenders. My shop personally, Libertas, we generally look somewhere between 13 and 20%, depending on factors like your industry type and the health of your banks.
Okay, great. So, what I would say is the line of credit is typically capped at, anywhere from 25% to 80% of a client's monthly revenue. Meaning, if you're doing $100,000 each and every month, you can expect a line of credit anywhere from $20,000 to $25,000 to $80,000. MCAs would go considerably higher, and SBA loans would go, a multiple.
Obviously,
of,
those would be the largest cap.
Absolutely, they would go a multiple of 10 because
it's stretched out over 5 years.
5 to 10 years. We actually have programs now that go 10 years, monthly payments, 5 to 12% interest. So in a program like that, spreading it out over more time, it's ideal for clients because they'll get a larger amount of funding.
So, John, for SBA loans, it's actually only ideal for certain clients. Many clients prefer a shorter-term product because they need to keep going for that cash. So that's where the credit line and the MCA becomes important.
Absolutely. Again, I could break this down a million ways to Sunday. It's going to matter what the clients are doing with the financing. If a client is buying inventory, a client typically has to buy inventory every month. So keeping it on a shorter term makes a lot more sense. If somebody is going to go and buy a building or open another location, it makes a little bit more sense to go out longer term and try and get an SBA. again, the disadvantage of the SBA is it could take you 30 to 90 days from application to money in your account. So let's talk a little bit about credit and and it's both personal and business. Now, before you go into what the MCAs are looking for, I can tell you this, that when you apply for an SBA loan or a line of credit, they're going to look at both personal and business. There are certain companies that will do a merchant cash advance only looking at personal. Libertas is not one of them, which is why I want Joe to fill everybody in that's listening on what are you looking at when it comes to credit, and how does that pertain to clients and business owners getting approved?
John, one of the biggest misconceptions about credit in this industry is that it's just the score that matters. Most lenders these days are a lot smarter than that. They're looking at what types of trades you have, how many trades, and the age. Typically we like to see files that have larger trades such as auto loans, mortgages, things that show that the merchant has put down roots. Libertas happens to look at both personal and business, which isn't something that everyone in the industry does, business credit especially. Now, business credit shows the trades that your business is paying. A lot of people report, such as food vendors, freight forwarders, people like that. Certain credit agency or certain credit giving institutions will also report, certain MCA companies, most SBA loans.
Okay. So now that I understand that, and I just want to clear this up, Libertas is one of the companies that will look at all the credit makeup. There are some companies or underwriters that we work with that will literally just look at a score. So if you have bad credit but it's over 500, I really wouldn't worry about it too much. It's just some of our better underwriters, such as Libertas, and there's a ton others, it may be a little harder to get into one of their programs. But you could always graduate once they see that you can handle financing. It's much easier to get you approved and graduate you into better programs. Let's talk a little bit about industry type. I don't want to spend too much time on it. I can tell you that lines of credit are pretty open to the industry type. So as long as you have 650 credit or better, and that's, again, I should have discussed that when we were going over credit, but if you have 650 credit FICO score or higher, you can apply for a line of credit. For an SBA, it's 650 is a little on the low end. I've seen it get done, but really you're looking at 680 or better.
So now, John, for the merchant cash advance product, the industry type actually plays a much larger role than it does in traditional financing. Obviously, we factor in certain things for risk. Over 75% of transportation and construction deals will fail in their first year. So obviously those are industries that we tend to shy away from with this type of finance.
Okay, so trucking and transportation and construction. Now, can you break that down a little bit further? Because there are other factors that go into it. So
now, obviously, where you're located in the country plays a huge role in this. California is by far the worst performing state when it comes to any type of business, but construction especially. This is once again something that has to do with deposit frequency. So when there's these types of industries, you tend to have a lower number of deposits per month.
Okay, so let's clear this up a little bit more. So one of the things that's going on is if you're home-based and you're in trucking or construction, it's a little bit harder to get financed. We can do it. Libertas is not someone that we would work with because you're not going to score out high enough in their risk assessment. The other thing that they're going to look at when it's a high-risk industry, those other factors are going to play a much larger role, such as deposit frequency, health of the banks, and time in business. Is that correct in saying that?
That's all correct.
All right, so moving on, let's talk about profitability. And profitability really comes into play when you are talking about MCAs that, Joe, go on.
So with profitability, John, what we're really looking for is a merchant's ability to handle our payment. Obviously, if your business has no cash flow available, we're not going to be able to give you much because of the fact that you can't afford to pay us back safely. The last thing that we want to do as a funder is hurt your business. We want you to be able to grow with us. So we want to make sure that the payment we're structuring is comfortable for you. Now, obviously, profitability plays a role in that.
Okay. And do you think that you can structure programs that mirror and mimic lines of credit?
Oh, absolutely, John. We actually do that for several of our clients.
And how do you do that?
So basically,